Welcome to episode number 30 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR. And today, we're talking a lot about apartments. We got a big update on the U.S. apartment market, our Q2 2025 U.S. apartment market update and outlook. New fresh data is in, so we'll talk about what we're seeing so far. And punchline is not yet any real sign of a slowdown. Even in Washington, D.C., where obviously federal layoffs have taken place and have been causing a lot of people focusing on that market to see what might happen, what the impact might be. And then, of course, more recently, tariffs. No sign yet of impact from tariffs on apartment demand or rents. But of course, all this is happening in very real time. And so we've got eyes on it. Obviously, everybody does. We'll see where this thing goes. I'm going to dive more into the potential tariff impacts in next week's episode. This week, we're going to focus on the current state of the apartment market and the latest data, sprinkle in a little bit of tariff conversation. You can't avoid it completely, of course. And I'll talk about a little bit also with our guest today, good friend of mine and one of the great minds in research in multifamily, Mr. Lee Everett, the EVP and head of research for Cortland, America's 9th largest apartment owner. So that'll be a great conversation. All right, before we get into today's numbers, big shout out to our sponsors, Madera Residential. You can check them out at maderaresidential.com, and also to JPI, one of America's leading apartment developers. All right, so we kick it off with, here's a chart. And we got a bunch of charts for those watching the screen. If not, I will navigate you through it. The first one's about supply. Obviously, supply remains the big story. Good news for owners and investors is that the peak is now behind us. When you look at quarterly deliveries, trailing 3 month, we peaked in the second half of last year. We got around or above 150,000 units completed in Q2, Q3, and Q4 of 2024, and pretty consistently around that number. In Q1 of 2025, that number did come down substantially, still elevated by historical standards, but down to 116,000, which is, again, comfortably below the 150 plus that we were at the previous 3 quarters, and looking more like what we saw in 2023. Now, in fairness, for any other quarter prior to 23, that'd still be a massive number. Okay, so it's not like the floodgates just stopped all of a sudden. It's still a big number, but we are past the peaks, and we got a couple more quarters of elevated supply on the way before it starts to really drop off in the end of the year, and especially in 2026. And of course, I've covered this extensively, so I'm not going to talk a lot about starts today. But starts by every account where you look at CoStar, RealPage, Yardi, census data, starts continue to come down. And obviously, one clear impact of tariffs could be, further uncertainty and further increases in construction costs, which could prolong the drop off in starts, or at least keep these numbers at pretty low levels. All right, so while supply is starting to moderate, apartment demand is actually picking up. We just saw the best first quarter in the last few decades, at least, here in 2025. RealPage shows that number at 138,000 units absorbed in Q1 of 2025. CoStar had that number around 127,000 units absorbed on net in first quarter of 2025. So either way, whichever data source you prefer, it's a big number. RealPage's was the biggest Q1 on record. CoStar's was the second biggest Q1 on record behind 2021. Again, either way, it's a big number. So where's that demand going? It's really going everywhere. And I think that's a pretty remarkable part of the story. It's going in the SunBelt, all that supply is. The leaders right now are, you can see from this chart for those looking at the screen, DFW, more than 10,000 units absorbed just in Q1, which is crazy. Atlanta and Phoenix ranking second, third, around 7,500 units absorbed in Q1. Also in the top 20, we got Austin, Charlotte, Tampa, Houston, Orlando, San Antonio, Raleigh, Durham, Fort Lauderdale, all Sunbelt markets above 2,500 or so units. But also we got some coastal markets making an appearance. We've seen some good demand numbers. It's not necessarily record demand in some of these markets because they don't have as much supply to absorb, but still very strong demand on a historical basis or historical comparison. Places like New York was fourth, 6,600 units absorbed. Northern New Jersey next door, just under 4,000 units. Chicago under 4,000 units. LA 3,400 units. Minneapolis in the Midwest making some noise as well as Seattle, Washington D.C., Boston, Philadelphia, all showing up in the top 20. So good story all across the country, coast to coast, Midwest, and Sunbelt. And it's not just the new lease side; it's also retention. It's that backdoor remains at a pretty, it remains pretty tight. You don't have a lot of folks leaving, even with all of these options that people have to move out. And so I talked about this in a recent episode, focused on why retention rates remain so high. So I won't repeat all of that here. You can find that episode a couple episodes back. It's the episode with Dom Beveridge, but 56.3% retention rate through February, which was the highest on a trailing 12-month basis in 2.5 years. Again, despite the increased availability. So pretty remarkable story. A lot of demand on the front door, a lot of demand on the back door, and not just because of fewer people leaving for home purchase, but obviously when you have this much demand, you don't have when you have net new demand, these aren't people who are would-be homeowners. You have obviously some of that of people who are staying put longer, but the net new demand means people are entering the rental market for the first time. And that's still a good story that reflects the fact that we've got young adults leaving the nest, going to apartments for the first time. We've had that for the last few years. We've got good job growth and wage growth still happening, especially among the core apartment demographic. Those are the things that are really impacting this new lease demand. All right, so the impact on rents. Apartment rent growth is slowly crawling back up. We're at a 21-month high of 1.1%, the first time above 1% since June of 2023. So still well below the kind of pre-supply wave norms, but that number is slowly ticking back up. And when you look at where that momentum is coming from, just like the demand story, it's really happening all over the country. We're seeing it on the coast, we're seeing it in the Midwest, and we're seeing it in the Sunbelt. We got a chart here showing the markets that have seen the most improved momentum over the last 3 months, from December to March in year-over-year rent growth. And what you'll see is places like number one with San Antonio up 260 bips on year-over-year rent growth. We've got Raleigh-Durham up 200. Also in the Sun Belt, we've got Dallas up 150 bips on rent change. Now, some of those markets are still negative, but they're trending in the right direction. We got the Midwest. We got St. Louis up 220 bips. We've got Kansas City, Cincinnati, Chicago, all up 170 to 200 bips. And then on the coast, we've got New York up 200 bips on year-over-year rent growth. We've got even Oakland, California, which obviously is taking it on the chin in this cycle, and they're up 170 bips, and then just south of there, or way south of there in Orange County, California, up 160. So improved momentum all across the board in every region of the country. Now, when you look at actual rent growth leaders, it's still a very clean relationship between supply and rents. So lest there ever be any doubt, it's all about supply and demand. There's a perfect illustration of that here. Market leaders for rent growth year over year for new lease effective rent change remain mostly Northeast, Mid-Atlantic. A lot of college towns have been the story for a while now, led by low supplied college towns like Champaign-Urbana in Illinois, Lexington, Kentucky, Syracuse, New York, all seeing little supply plus rent growth of around or above 6%. Among larger markets, Kansas City leading the way, plus 5%, followed by Chicago and Pittsburgh, both above 4%. One really positive re-emerging story right now is San Jose, with Silicon Valley tech jobs returning. Rents there now up 3.9%. And even San Francisco next door, now up 3.5%, though still a hole to dig out of there. Other notables above 3% year-over-year rent growth include Cincinnati, Columbus, Detroit, Washington, D.C., Milwaukee, New York, Baltimore, and northern New Jersey. Now, in the Sun Belt, of course, still a lot of supply to deal with, and that's leading to concessions and rent cuts, but the rent cuts are moderating. And some are actually positive again in terms of rents. Tampa, most notably, up 1.6%. This is one that some of the REITs highlighted as an early recovering market. And also my guest in the Q1 apartment update, Greg Willett, he highlighted that one as well. So it's happening. Miami is up 0.2%. And then Houston, this is one I told you could be a surprise on the upside this year, given lesser supply pressures there, up 0.2%. So it's the first non-Florida Sunbelt market to return to positive territory on rents. And, I tell the story all the time, or the stat all the time, but a great stat on Houston, throughout this entire supply cycle, its construction rate relative to its inventory was below not just the Sun Belt or Texas, but below the U.S. average. It's pretty remarkable for a market with the type of demand they have in the Houston metro area. Another surprising story with rents approaching positive territory again is Charlotte, North Carolina. Charlotte has supply levels akin to Nashville and Austin, but it's held up a little better than the other two, and especially better than Austin. Rents there are still down, but the rent cuts are now less than 1%. On the flip side, Austin is still leading the country with the deepest rent cut among large markets, rents down 6.4%. Trending incrementally in the right direction, but still a big hole to dig out of. So with rents still, they're climbing up, but still at a very moderate level, income still climbing. Positive story here is that wages have now outpaced rents for 27 months and counting. That should likely continue for most this year, barring a massive disruption from the tariff story, which again is possible, but we just don't know at this point. There's a lot of unknowns. And so I don't want to be one of those guys adding fuel to the fire with saying things we just don't know yet. Obviously, the range of possibility is quite broad. But for now, the affordability story really remains more of a tailwind than a headwind among the market rate apartment and SFR renters. Wage is up 4.3% year over year. Rents, and this is through February, that's the latest data we have for wage growth. Rents through the same time period are up about 0.8%, now at 1.1%. So again, I've said this before, when wage growth outpaces rent growth, that widens the demand funnel. That's a win-win both for renters and for investors. All right, so let's talk about CPI for a moment. The CPI rent inflation numbers came in recently, and through March, that number dropped below 4% for the first time in more than 3 years at 3.99%. Now, obviously, the CPI version of rent, what they call rent to primary residence, it lags significantly behind the real-time rents we see from asking rent data. And I won't go into all the mechanics of that. I've talked about that before, but it does significantly lag. But it's down well below the peak that it was at nearly 9% back in 2023. And it's going to keep cooling given the lag nature of this metric, even with the new lease rent starting to show a little momentum again. Now, I've said this analogy before, but when you look at the CPI version of rent, which plays a massive role in how we measure inflation in this country, it's not just the renter side of it. Remember, it's a survey of renters that is the primary variable in how we measure all shelter costs, which are about 30+% of the weighting of the consumer price index. So that owner's equivalent rent, that's the primary variable in that. You could fact check this. Go to the Bureau of Labor Statistics website. The primary variable is a survey of renters, the same survey used to measure the rent. It's the same survey. And so you can go find that on the website if you doubt me. But this is critical. And so I've used this analogy before, but it's like looking at this number, it's like an 18-wheeler riding its brakes down the mountain. We know where it's going. It's just going to take some time to get there, and that number is going to keep coming down. But we're basically back to the pre-pandemic norm on CPI rent inflation, which was just below 4%. All right, so all this rent that deceleration, of course, has been supply-driven, but the mainstream thesis has been rents would increase as supply tapers off, and we're seeing the early stages of that starting to happen on rents, as I noted. And here's yet another sign that it's happening on the supply side, the supply slowdown. When we look at what's left under construction, now that apartment starts have plummeted and far more is completing than starting, we're at 585,000 units left under construction in the U.S. Now, that's still a fairly significant number, but it's the lowest since 2018, and it's nowhere near the 1.1 million peak, the peak of 1.1 million units, I should say, that occurred a couple of years ago. So it's going to keep trending downward as completions outpace new starts here in 2025. And before we move on, let's take a quick look at apartment sales activity. Apartment sales volumes are ticking back up. About 145 billion trading in U.S. apartments over the last 12 months. That compares to this time last year when we were around the bottom, about 109 billion traded at the same time last year on a trailing 12-month basis. Of course, we're still way less than even half the peaks of 21 and 22 when sales topped $400 billion nationally, the all-time highs. Prior to that, the record highs were about 200 billion, just for context here. So we're about 3/4 the way to the 2019 levels, and we're nowhere near the all-time high level set a couple of years back. So obviously right now, some big question marks around debt and equity going forward. Lee, when we talk to Lee or later on today's program about the tariff impact, he'll mention that they're seeing some debt funds that are pulling back a little bit and or even significantly, given the uncertainty driven by potential tariff impacts. So we'll see where these numbers go going forward. But so far, they have been trending gradually upward. All right, let's jump into rental housing trivia. All right, this week's trivia question is, on a size-adjusted basis, New York has added the least amount of new apartment supply over the last 5 years, just 0.5% average annual inventory expansion. Among markets in the top 50 for size, what ranks second for least supply added over these last 5 years? So give that some thought. Next up, in the news. All right, a couple of headlines for us this week. The first one comes from The Real Deal. Rent-stabilized shortfalls may grow exponentially, new data shows. NYU's Furman Center found declines in older, heavily rent-stabilized Bronx buildings. All right, so it's no longer just landlords and their advocates screaming into the void for the ruination of rent-stabilized housing. By the way, I should have said this. I'm quoting from the article. That's not my own dramatic flair. This is from The Real Deal. They always are a bit colorful in a good way. NYU's Furman Center has joined the din. At the Rent Guidelines Board's second meeting of 2025, New York University's Center for Housing Research presented data showing that older, entirely rent-stabilized buildings, particularly those in the Bronx, are grappling with revenue shortfalls caused by the Housing Stability and Tenant Protection Act of 2019. That act made it impossible to substantially raise rents outside of the annual adjustments approved by the RGB, that's the rent board, which have historically failed to keep pace with inflation. All right, so here's from the Furman testimony. They said, and Furman's a kind of a leading research lab for real estate. They wrote, the finding that rent increases were falling short of the amount needed to cover rent increases and operating costs and overall inflation indicates that such rent shortfalls are likely to continue to grow over time, potentially exponentially, and jeopardizing the long-run economic sustainability of these properties. And he says, this generational challenge presents an opportunity for New York's lawmakers to find ways to preserve the stock for the long term. All right, so just, finally, my own commentary here after reading from the article a little bit and from the study. Obviously, this is yet another example of the law of unintended consequences with rent control backfiring the very people it's intended to protect, as these properties risk further eroding into obsolescence. All right. Another headline, this one comes from the Los Angeles Times. The headline is, LA City Council backs huge trash fee hikes for residents. Okay, so some of you already know where I'm going with this, okay? Let me read it from a little bit from this article. The LA City Council moved Friday to dramatically increase trash fees in a bid to raise money and close $1 billion budget deficit. On a 10-1 vote, 10-1, the council ordered city attorneys to draft an ordinance raising the fees on roughly 740,000 customers, with council members arguing that the city has subsidized the cost of trash pickup for too many years. Owners of single-family homes and duplexes will see their trash fees go up 54% in the coming year. And then on the monthly bills, these increases will show up on a line item, solid resource fee. Okay. All right. So first of all, apartments are classified as commercial kind of for trash collection. So they have a different fee for those large bins. But hear me out. Here's the irony of all this. There's all this stuff going on right now about junk fees. And it's funny, the junk fees, and we're talking about trash, trash and junk. The cynics say apartments and single-family rentals charge junk fees that should be covered by the base rent. And yet cities charge a literal junk fee, a trash fee, and label it on bills under an obscure name, solid resource fee. So if everything for renters should be covered by rent, why shouldn't everything for homeowners be provided by property taxes? Seems like a double standard. The city of LA jacks up the fees. They tell us because of rising costs, they need to cover the budget. And that's what the media reports. And honestly, I don't doubt them. I think they're probably right. But apartments and SFR owners raise fees, and they tell us it's because of greed and deception. And that's the tone of the media coverage much of the time. And it just reflects, I think some of the silliness of how some, but not all, policymakers and media talk about rental housing providers. Okay, let's get back to our rental housing trivia question of the week. On a size-adjusted basis, New York has had the least amount of new apartment supply over the last 5 years, so just 0.5% annual inventory expansion among markets in the top 50 for size. What ranks second? And the answer is, it was a little bit of a trick question, it's 2, tied. Detroit and Pittsburgh tied 0.7% inventory expansion over these last 5 years. So very little supply growth in much of the Midwest, especially Pittsburgh and Detroit. Although Pittsburgh technically is a Northeast market by definition of the census, but we'll call it close enough to the Midwest. All right, that'll transition us to today's interview, where I am thrilled to be welcoming in my friend and one of the greatest minds in multifamily research, Lee Everett, EVP and Head of Research at Cortland. All right, welcome to the interview portion of today's podcast, and I am honored to be joined by the pride of Youngstown, Ohio, and now the head of research and executive vice president at Cortland, the nation's 9th largest apartment owner, Mr. Lee Everett. So Lee, thanks for being with us today.
No problem, and it's great to see you as always, Jay.
Absolutely. So I want to start off with this. Can you share briefly your journey getting into multifamily research? You've I'm sure some of your fans have seen you on TV and on the Odd Lots podcast. So was it talk about your journey? Was it the shoulder injury in high school that derailed your pro football career and sent you into research?
In a wild way, college football does play a bit of a role. I initially had went to a school called Youngstown State as a local meathead and was headed there to play college football. I realized after about a year that the NFL was not in my future and transferred to Johns Hopkins. And that story was actually one of the things that inspired me getting hired for my first ever real estate job. I am the rare real estate researcher that has been in this space forever. I've seen multitude of cycles at this point. I joined the space in 2006 at a firm called the Concord Group, where I helped launch their Boston office. And Jeff Glue at the time actually loved that sort of desire to transfer and give up sports. And it was one of the reasons he hired me. The Concord Group was great. So my first experience in the space was cutting my teeth doing the real nitty gritty stuff, feasibility studies, supply demand analyses, product programming. And we were at that point in time, there wasn't really CoStar or Axio. So you were getting your data the old fashioned way, dressing up in secret shopping, calling people, beating on doors, visiting sites all over the country. And from there, I've just been in the space for almost 20 years now.
Yeah. Seen a few things in that time. So big picture, what's your elevator pitch in the state of the apartment market right now? Let's put tariffs aside for a minute. We'll come back to that. I know everybody's asking about that right now, but just big picture, how do you see apartments?
I think at the highest macro level, there's two facts that give us a strong sort of long-term outlook. First off, the baby boomers are retiring at a very rapid rate. They're going to continue retiring. Current economic issues aside, in the long term, I expect them to be net spenders, net consumers in the economy, while no longer being producers. I think that's driven an exceptionally tight labor market for the younger people. higher wages, more jobs. It's a very, very different reality than it was a decade ago. And I think even if we were to, worst case scenario, hit a GFC level event, I think at the other side of it, you still return to these macro factors of very tight labor force, young people making money, and young people needing a place to live. Well, at the same time, the supply constraints are very real. Anything that's getting started today is getting started typically much further out in a much less desirable location than people are going to want. At the same time, starts are falling. And to go back to sort of starts falling in an environment that's been a strong economy. If the economy continues to unwind here, you're just going to see starts continue to fall in a stronger and quicker fashion. And you're going to very quickly get to an exceptionally low supply environment. And that's going to be even more clear in the higher quality locations. And that's set up value add players, core players on the case that they have money to come into these high quality locations and provide people this well connected, well located, well maintained housing alternative. And I think that demand story is the story of the back half of this decade. When we're able to see that come to fruition, I think depends a lot on the current economic crisis, if you will.
Yeah, so let's get into that. So all of us in a research role, you and me included, are getting pounded with that question right now. What's the impact of tariffs? And I want to get your take. But honestly, it's tough because there's just not a lot of data to work with yet. There's not really clear historical precedent to the current moment. Not yet any clear. I think the impact is obviously a little more clear, or at least easier to predict on construction costs than it is on the demand side. So, to me, the bigger fear is a trade war leading to a recession, which of course could weaken apartment demand. So I'm curious, what's your take? When you get asked about tariffs, impact on multifamily, how do you respond?
I think there's three ways to look at it. First off, on the fundamentals side, the story of our economy, as I mentioned, that sort of baby boomers leaving the productive labor force, they've been massive consumers. We have seen top 10% consumption really drive a lot of what's happening in this economy. Where I'm a bit concerned about the consumer is stock market hits, bond disaster, dollar devaluation. That all typically leads to older people spending a lot less money. And I think that's where you could see some cascading shorter term layoffs through the labor market. But at a 4% unemployment rate, I think we're well positioned to absorb that type of hit, short term disruption, et cetera. A bit of a longer term concern, consumer sentiment is very negative right now. There is typically a correlation between that and household formation. If this drags on and continues for a while, that sentiment stays long, it could be a longer term, I think, demand slowdown. A short term plunge in sentiment, I'm not worried about. A long term one, I could see hitting demand. But I think the biggest issue, this has gone from a consumer driven concern to a financial market concern. You couldn't get the banks on the phone 2 days ago to get debt. You're seeing the debt funds pool bids they have out on active bids for people. And this kind of volatility and this sort of three-tiered hit in the market is a big threat to dry up debt liquidity when, a month ago, that was everyone's rallying cry. Everyone wants to lend. Debt spreads are coming in. Everyone's going to be able to get back to the market. And we've seen that more than reverse course over the course of this last 10 days.
Yeah, no, that's a great point. And by the way, just on the consumer sentiment thing, it's interesting because for a while the story has been people perceive the economy to be worse than their own personal situation. They think they're fine, everyone else is struggling. But now, this is obviously a bigger question of just broader uncertainty. But I want to ask you more about you talk about the debt fund. So how is that impacting? Obviously Cortland's an active buyer in the market. You're looking everywhere. So how's that impacting what you're seeing in terms of active deals in the market, bidding, number of players on these deals? What are you seeing and hearing?
At the very moment, there has not been a real drop-off. We brought a deal in a major Texas city to market last week, and I think we got 20 bids. It was very good, a very deep bench. Now, a week later, I would expect retrades to start rolling in on that deal. But I think the apartment market is still in a place where the fundamentals are improving enough. People are going to bid. People are going to try to be in a position where if this stuff stabilizes, if a long-term deal is cut that takes away this turmoil, they can act and act quickly. And if this is a short-term disruption, people want to be positioned to go.
Yeah, especially if you like the long-term story for multifamily, which obviously a lot of investors do. So let's talk. Go ahead.
I do think on that point, it's worth stating one other thing, right? In the people are going to allocate to real estate on the investor side. And in the CRE space, no asset class is as well positioned to absorb any recessionary effect as multifamily. It's forever been considered a defensive asset, and that's because short lease terms, the ability to manage to occupancy, and what you've seen over the course of savings and loan, Great Recession, COVID, you saw NOI growth come in, slow less than the other property types, and spike immediately thereafter after the recession. And the defensive positioning here, I do think from an investor standpoint, will make multifamily much more attractive relative to the other sort of two golden childs of this era, industrial and data centers, where you're likely to see a lot more of a hit driven by tariffs and things along those lines.
Absolutely. Great point. Yeah, the resiliency of the sector of these last few downturns has been obviously pretty remarkable. So let's talk about something a little bit clearer grasp on right now. That's apartment fundamentals. And again, there's obviously some big question marks on the horizon, but let's just look at what we know, okay? Demand's been strong. You allude to supply. It's peaked. It's coming down, especially as we get into later this year into 2026. Not going to be a lot of supply. Cortland, y'all are in a bunch of markets all across the country. So where are you seeing the earliest signs of demand catching up with supply and rent starting to rebound?
I think is a kind of fun exercise. Let's start with one of our smaller markets, Boise, where we do have decent exposure, but the market itself is slow. Everybody knows Boise spiked to like 35, 40% of inventory under construction. Well, we're past their peak by a good bit, and we've seen market rents turn positive there, not even just term rents. And to make sure to highlight that difference, right? Term rents, you're impacted by renewals. At no point this cycle have we really seen renewals turn negative. So your term rents have continued growing in a lot of instances where your market haven't. We've seen Miami turn positive. We've seen real strength in DC and our Northern Virginia exposure. That's a market also on the other side of the supply wave. We're starting to see signs of Atlanta turning. Dallas has kind of been up and down on a market rent standpoint for us. It's chugging along, if you will, negative to positive, trying to find its way out. Southeast Florida continues to perform well. So you're really starting to see some clarity. I mean, the Austins, the Charlottes of the world, they're going to continue to lag a bit more. Downtown Nashville too. But outside of that, you're starting to see green shoots generally across the portfolio.
Yeah, that certainly aligns with what we're seeing in some of the national data too. So, as you know, the big data providers, and I think a lot of the mainstream view right now is that rent growth can be returning to, again, let's take the current moment aside. We don't know what the impact of tariffs is going to be later this year, but the current trajectory has been that most of these markets will return to positive rent growth by the end of the year, maybe low single digits for now. Are you on board with that kind of mainstream view at this point?
100%. I think you're going to have a few laggards, but we just had in our footprint the second strongest demand quarter ever per CoStar. We were coming off the second strongest demand year on record. Everything peak supply is at the latest Q1 in any market we're exposed to. We're really feeling good. And as I kind of alluded to earlier, even outside of the few urban nodes, a lot of that later cycle supply peak is much further out from the cores. I mean, Atlanta is a great example. You still have some supply in Midtown, but Buckhead is done. You can't find new product in Buckhead at this point in time. You want to go 45 minutes outside of the core of the city, you can find some new starts, but there are these sort of very sub-market specific dry ups that are happening that I think are going to give us some good pop as we start to get into late 25 and into 26.
So what about 26 and 27 then? What's your baseline forecast nationally for the next couple of years?
That's where we're expecting a good pop. We're expecting stability with submarket specific positivity over the course of this year. We think as you hit 26 and 27, you return to more of the last cycle norm and possibly some stronger pops just in the short term as you sort of see that grind out. And it's really going to be a question on the supply side, right? Like, this slowdown is known. There's a chance that the markets push this slowdown into 28 and 29, given what's happening. And in that case, it might take longer for that big pop, but you're likely to see a longer big pop thereafter.
Yeah, I always tell folks, like, I wouldn't necessarily want to underwrite, upper single digit rent growth, but you could certainly make a case for that. But obviously, if you're from an underwriting standpoint, you're probably going to be safer. And like you said, I think pre-COVID norms are probably 3-4+% is probably a safe number.
Yeah, there's a world where you see the eights. I don't want to be the one underwriting it today.
No, you want that to be the upside.
Yep.
So let's talk about the Sunbelt specifically. Obviously, Cortland has a big presence there. You're based in Atlanta. And you and I have talked about this a lot over the years. I mean, the Sunbelt has been outperformers on rents, not only during COVID, but a lot of people forget that it was really throughout most of the decade prior to that too, or at least the last 7 or 8 years of it. I think, again, as you kind of know my take on this, but I think a lot of markets, as you alluded to, are entering this lower supply environment. We're still going to see strong demand, even if it's not quite as off the charts as it has been. I think we'll see those markets back on some of them, at least on the national leaderboard again, as demand outpaces supply. But what's your take? I mean, do you agree? And if so, when do you think we'll see that start to play out?
It's interesting because I think the gateway markets are better positioned than they were last cycle, given the rush of supply on the reurbanization of America. So I think they've got a much better supply side story. But if you think about the immigration aspect, the gateway markets are heavily, heavily reliant on foreign immigration. You've seen this story. The boomers did this. You've seen Gen X do it. The millennials are doing it now. Americans in expensive locations have children and move to cheaper places. It's been the American way throughout history. And the Sunbelt's uniquely positioned where I expect demand to continue to outperform with or without immigration. There could be real challenges to the New Yorks, the LAs, the SFs of the world there. So our view remains exceptionally strong. We actually think going into this, despite strength in a Chicago that you're seeing today, because let's face it, Chicago supply peaked in 2018. It was due for an outperformance period. But being in natural population growth locations, we think will give us an edge, particularly through this period. And then in the same degree, household formation, as it ticks up in a stronger economic environment, has generally favored the Sunbelt. So we remain bullish. And I want to clarify, we have more exposure than just the Sunbelt, but we're at the same time chasing these growth markets. We have Midwest exposure in Columbus. We're in Northern Virginia and continuing to look to expand in DC, but we've been primarily in Northern Virginia. We have mountain exposure in Colorado and the surrounding areas there. And this select sort of diversification market-wise is meant for us to be able to enjoy population growth in a variety of places.
Absolutely, yeah, and you obviously a lot of these markets from your past as well, and spending some time looking at these and helping invest in them. But yeah, I think great point on immigration. I think I've dealt with this question a lot. People think, hey, the southern states are closer to the border, therefore they're more exposed. But when you look at the data, you're right. Like the big coastal markets, particularly New York and California, are much more reliant on international migration. They tend to be domestic migration net losers, and also have slower or weaker birth minus deaths impact. Some cases negative in some of these MSAs. So that does, I think, create a bigger question mark on some of those spots.
If you, throughout our portfolio, just look at net migration plus births minus deaths, the only markets that go negative are Southeast Florida.
Yeah.
Which that's truly the story for where we're at today.
Absolutely. So you mentioned Columbus. I want to talk about Columbus because I think there's a great story here. Cortland, I remember, unfortunately, I can't give you the credit for this. It happened before your time. But I remember Cortland was one of the first big national players to enter the Columbus, Ohio market. And now we're starting to see others that are following suit. I think Columbus has entered that. It's now in that group of markets that's highly liquid, more institutional. Are there any other markets like that you all see that could be the next Columbus, attractive market that doesn't have institutional favor and liquidity today, but could get there?
I think you've seen that start in a few different Midwestern markets. Indianapolis, I think, is a very similar story. You've got a huge logistics base. The downtowns come back to life. And what's nice about an Indianapolis, and even more so a Columbus, is they're low beta markets, right? Columbus never gets hit as hard. It never grows as much, but you've got positive population growth, a good business environment, and real stability. Indianapolis can get there to a degree. There's deals on one-off basis and one-off neighborhoods in Kansas City that have looked good. I do think downtown Detroit's having a bit of a return, but that's kind of all Dan Gilbert's ballgame. I don't really foresee a lot of people entering there. But the moral of the story is stable Midwestern markets that are positive on the population side or specific areas that are, I think, could see some positive institutional action over the course of coming up. I mean, the Trilogy portfolio that just traded was a heavy Midwestern exposure. So I think that's the sort of next endeavor. We went through the gateway crazes last cycle. That turned into the SunBelt craze in the midpoint of last cycle and coming out. And now I think it's a bit of the Midwest turn to be the new hotbed, if you will.
Yeah, you mentioned Trilogy. It was 3,000 units that Morgan Properties bought. And there was a great stat in the article about this where they said that Morgan had fewer than 1,000 Midwest units back in 2019 before COVID. Now they're at, 14,000 or something. So it's a good thing. But let me ask you this, though, just on the Midwest, because there's been so little construction over the last couple of decades, there's not a lot of kind of institutional grade product in some of these markets. So how do you think that's going to shape some of the, how those markets play out?
I mean, that's a bit of the rub, right? Why there's only specific markets or submarkets where it'll work. Columbus and Indianapolis have had building booms. There's parts of Kansas City that got a lot of attention over the course of last cycle. Chicago got a lot of attention last cycle. But to your point, this isn't this large, massive swath. But when we were touring the Trilogy portfolio, ended up in Louisville touring that asset. And there's probably 5 real relevant comps in the area. All were institutional caliber, all were like 98% occupied, and all were just kind of chugging along. Now, that node would get crushed if it had an onslaught of supply, but I don't see how you could really pencil new supply there. So even a submarket like that probably had 3 to 5 institutional buildings has some positives if you just want to sweep cash flows. Ultimately, that was not a portfolio we bid overly aggressive on. We didn't bid the whole portfolio. We weeded out some assets, but on a one-off basis, there was some real interesting exposure to institutional product in nodes you wouldn't have expected.
Yeah. Yeah. Like you said, it's a low beta market. You're not going to ever probably see massive volumes of construction in some of these spots. So what about vintages and asset classes? You and I've talked about this before too. Institutional capital in this cycle has really moved up market. Newer product, class A or B plus. I think especially I hate when people say B/C. There's a big difference between B and C, and I think we're seeing that now. Do you think that'll remain the better bet going forward, or at what point do you think the C or B minus product that's from the 70s and 80s starts to get more attractive again?
I think it depends on the player, right? We'll go in and buy just about anything, rip it to the studs and rebuild it. We're about as vertically integrated and good at renovation as it gets. Some other shops like to take a lighter touch, but I do think some of the bad debt in the C space problems are likely to remain. I think immigration issues are likely to hit that space harder than the higher up space. And frankly, I do think those are the people that struggled the most with inflation. So I don't really see a quick turn there. I continue to think it's kind of, if you're a cash flow based investor, B to B plus. If you're looking to marry cash flow with returns, it's kind of a B to an A without the luxury. If you're a longer term holder, it's more of the luxury. But, and I think you were at the meeting at Priya, Suzanne Mulvey shared a great chart. Typically, I think she was showing 40% of all product 5 years or younger trades. And over the course of the last year, we've had 10% trade. So there's a lack of core buyers at the top of the market that's created some opportunity there that once some core funds open up, I expect that market to move. Where you've really seen movement over the course of the last 2 years has been the value add space, where people can underwrite rent bumps, but also can still easily position themselves below the expensive new construction. Value add's really been the favored. I think you will over time here see some move back into core, just because frankly, that's where you're seeing the loosest cap rates in the market today. And I think that's kind of the transition you'll see. I don't expect a lot of players to move further down the quality spectrum. It's just a difficult place to play. And as you've harped on many a time, the government's not very interested in helping people operate in a more affordable space.
But let me go back to something you said, though, about the buyer pool has been, there's not been as much trading in the top of the market, but a lot of that's like there's a lot of would-be buyers, but the sellers, I mean, those sellers aren't like the C-Class C sellers. They're not in a position they have to sell. They're willing to wait this out. And so at some point, you're going to have to see buyers who want these assets are going to have to pay the prices that the sellers want for them.
Or the sellers eventually realize they can't keep kicking the can on their debt costs. We toured a 20 portfolio, high-end core portfolio. We were looking at it from a large pref perspective about a month ago, and it was us and the big boys like Blackstone, Ares, Starwood coming through. And I can tell you nobody offered anywhere close to what this family thought this large portfolio was worth. And the reality of the situation is their debt situation's really bad, and they aren't likely to get a lot more offers in that space. And we've executed a few pref type rescue capital, will take over operations deals in the last couple months on core deals. And I think you're going to start to see debt costs really become problematic for those, at least the newer and the less well-capitalized owners. Like I don't see the Cortlands, GIDs, et cetera, the world dumping core assets en masse. But a lot of people bought this stuff in 21 and 22 that shouldn't have. Frankly.
Yeah, so a lot of that's a good topic. So a lot of that's not necessarily going to show up in terms of foreclosure, but could eventually result in a forced sale that's like a lowercase d distress.
Yep. That's exactly the point I think I put on. And honestly, they're all out there looking for pref now. We probably value, I can't even guess how many core deals on a future value pref program. And we're having trouble getting to even the debt level on a lot of these deals. So that space is not as healthy as one would think. It's just you haven't seen a lot of the pricing deterioration because of a lack of movement.
Now, are you thinking about recent construction in particular, or just kind of core in general?
Recent construction and very high-end luxury. I think I'd say like the top of the market rents is generally where you're seeing it.
Yeah, absolutely. All right, so let's talk about another hot topic. Resident turnover, very low this entire cycle, as you know. Even prior, after I might be outside the industry all the time, it's like to talk to the media and whatnot. It's like, hey, this we had low turnover even before mortgage rates went up, before home prices shot up. It's been structurally low for a while. So I've been telling people for the last few years it's gonna go back up. We're gonna see some return to normal. But I've been wrong long enough that I'm starting to wonder and kind of doubt myself. Is low turnover just the structural new normal? Regardless what happens with home sales, particularly with operators, including yours, like Cortland, getting more sophisticated on resident engagement and creating a more seamless renewal process. What's your take?
I think it's twofold. I think we delivered so much at such a high price point. People looked at, sure, you're offering me 2 months of concessions, but I don't want to play the game and I have to chase concessions again next year. I mean, last cycle, you'd hear stories about in downtown LA, people just living out of suitcases and moving once a year because they chase the concessions. You haven't seen that today. And I think that's twofold. One, the price difference. Concessions don't stay around forever. People are smart enough to realize that at this point in time. And two, institutional product has been renovating, building, et cetera, now at high volume for a decade. And I think people are just realizing, my A minus building that's in the location I want and that is operated by a high caliber operator that provides me with the service and the baseline happiness that I want, it's not worth leaving them over a 3% renewal at this point in time. And I do think retention, provided there's no major economic event, is likely to stay strong. And also, right, if you think back to last cycle, coming out of the GFC, everybody had 2 to 5 roommates, right? I mean, there's all the stories about millennials that wanted to live in Manhattan, renting a studio and just putting 2 blankets up and sleeping 4 people into a room. That hasn't happened this cycle, right? These younger people are coming out with higher paying jobs. They're having 1 roommate, they're living alone. And I think the benefit of that in terms of retention is people are in a much more comfortable position that they were able to choose at this point in time.
Yeah, no, that's a really good point. And it's interesting too, the concession topic. You're right. We had so many concession hoppers in the past, and I don't think property managers don't give people enough credit sometimes. Like renters are not, they're smart. Like they could figure out the math here of what happens. And so I think that they can sometimes be gimmicky a little bit when at the end of the day people just want a better deal, not a gimmick.
Agreed, completely.
All right, well, Lee, it's been fun. I appreciate you making some time to talk the market, and we'll see how these next few months play out.
It's going to be a ride, that's for sure. Thanks, Jay.
Thanks, Lee. And that wraps up episode 30 of The Rent Roll. Big thanks to Lee for joining us. Thank you to all of you for spending part of your day with us. And thank you to Madeira and JPI for your sponsorship of The Rent Roll. We'll see you next week.